Hi everyone, I hope you are having a great day and thank you for joining us for this webinar. FocusEconomics is a leading provider of economic analysis and consensus forecasts for 128 countries, as well as for 30 commodities in our monthly economic intelligence reports. We work with our network of 66 analysts covering the Eurozone each month to build a consensus forecast for more than 30 key economic indicators. Overall, our network spans over 1,000 local and global analysts. As the year is coming to a close, all eyes are looking ahead at what 2019 will have in store. In this webinar, I will be discussing the economic outlook for the Eurozone next year. I'll start with a basic overview of 2018 and the Eurozone economy's current state of play. Next, I'll proceed by going over our outlook for 2019, with the focus on the main challenges and risks for the common currency bloc next year. In addition, I will provide a more in-depth look at a few key economies of the region. Let's begin with a brief overview of 2018 for the Eurozone economy, starting at the beginning. The Eurozone entered the year on a high note following a stellar 2017. The common currency bloc enjoyed its brightest growth spell since 2007, as GDP expanded a solid 2.5%. The recovery was powered by a tightening labor market, ultra-accommodative monetary policy, and solid export growth, which kept activity strong despite several political hurdles over the course of the year. Namely, uncertain elections, Greece's debt crisis, Brexit negotiations, and rising populism and anti-EU sentiment in the broader European Union. At the start of 2018, most of the tailwinds that fueled last year's robust growth spurt remained in play, setting the Eurozone up for another year of solid expansion. However, likewise, a number of 2017's challenges also lingered, including fractured electoral landscapes, looming Brexit, and political uncertainties, while new challenges sprung up throughout the year. However, what we saw was that despite many of 2017's tailwinds persisting, growth nearly halved at the start of 2018. GDP growth fell from the brisk, seasonally adjusted 0.7% quarter-on-quarter pace seen throughout most of last year to 0.4% in the first and second quarters. Moreover, a preliminary estimate released by Eurostat revealed that growth slid further in the third quarter, with GDP increasing a modest 0.2%, the worst result in 5 years. However, the third quarter's poor reading is likely partly due to one-off effects, especially as car production was disrupted by new emissions tests in the quarter, denting in particular Germany's momentum. Overall, what this year's growth slowdown was partly expected. It is typical that growth hits a peak in a recovery and then returns to normal levels. It was a much sharper deceleration than previously anticipated. A less favorable external environment has been at the heart of this sharp slowdown. At the start of the year, we had a strong euro denting export growth, while rising global protectionism, uncertainty over trade relations, and a slowdown in global trade flows has kept the external sector weak in the second quarter, and likely also played a role in the third quarter's poor reading. In addition, higher oil prices have pushed up inflation, especially in recent months, which is taking a bite out of household spending, and economic sentiment has fallen this year in the face of several political uncertainties. Here in the graph, you can see GDP, including for the third quarter, as well as private consumption and export growth. You can see clearly that the past few quarters of GDP growth have been weak, and this is a lot mirrored by what's going on in private consumption, which is the engine of the Eurozone economy. And as well as you can see that exports has been more volatile, but that exports actually contracted at the start of the year. While growth in the Eurozone has clearly entered a lower cruising speed, I want to stress that there's no reason to panic. The economy is still being supported by largely healthy fundamentals, and growth is expected to pick up from the poor reading in the third quarter. A tightening labor market and accommodative monetary policy should continue to buttress momentum, and the recovery is expected to remain on track, however, at a new normal slower growth rate than seen previously. After that look at 2018 and the Eurozone economy's current state of play, let's move on to our main forecast for next year. Next year, we see the Eurozone recovery remaining on track, although the economy will grow at a new slower speed. Overall, GDP growth is expected to wane somewhat. from a projected 2% in 2018 to 1.7% in 2019, which would mark the slowest growth rate since 2014 if confirmed. The deceleration is expected to be driven by more moderate investment growth and by a worsening performance by the external sector. However, household spending is actually seen gaining modest steam as the labor market continues to tighten and inflation remains in check. Looking at our other key forecasts, we see inflation remaining broadly steady and averaging 1.7% in 2019, below the ECB's target of close to, but below 2%. While inflation has hovered above the ECB's target in recent months, it is supposed to fall as the base effect of high oil prices fades. Regarding the bank, we see interest rates remaining at zero for most of the year, with our panel split on whether it will tighten the main policy rate by year-end. Our consensus forecast is for the refinancing rate to end the year at 0.16%. Meanwhile, the euro is seen strengthening against the US dollar after ending 2018 on a more moderate note. The euro has weakened recently, weighed on by political uncertainties and the interest rate differential between the two countries. The currency pair is expected to trade at 120 USD per euro at the end of 2019. While overall growth is expected to hold up in the Eurozone next year, the region is facing many challenges and headwinds to activity. Now I want to sort of shift focus and talk about one of our main risks to the outlook next year, which is a gloomier than expected global backdrop. Increasing global trade protectionism has already jittered global financial markets and trade this year, and if it intensifies, it could dampen the Eurozone's outlook. Exports have been a key component of Eurozone growth, and the threat of a global trade war would be very damaging for growth prospects. At the heart of rising global protectionism is United States President Donald Trump. He has upended the global status quo of lower trade barriers when he took office and has been a wild card in terms of policy making, adding uncertainty to the equation. He has already hit at the EU with levies on aluminum and steel and could decide to focus more attention on the Eurozone, given the region's large trade surplus with the American giant. While so far US measures have only affected a small proportion of EU goods, Trump has more than once threatened to levy sanctions on automotives, which is a much larger market. Moreover, spillover effects could dent confidence and weigh on investment next year, and they've already dented confidence this year. On a broader scale, rising global trade tensions could also exacerbate volatility in financial markets and hurt global growth overall. In recent weeks, global stock markets have fallen, and a continued decline could spark a negative wealth effect for the Eurozone. Moreover, cooling growth in China, which is one of the main buyers of European goods, due to the ongoing trade spat with the US and softer domestic dynamics, could reduce its purchases from overseas. Finally, despite declining in recent weeks, oil prices remain highly volatile, and concerns about supply could send them up, worsening the Eurozone's external position and eating into households' purchasing power. Now, I'd like to highlight another key risk to our outlook, which is political uncertainty within the Eurozone. In particular, Italy, the third largest economy in the region, is in focus. The unusual or unlikely coalition government, formed in June by the populist Five Star Movement and right-wing League Party, approved recently a spend-heavy budget for 2019, which envisions an increase in the fiscal deficit, breaking the government's commitment to narrow the deficit as required by the European Commission, essentially breaching EU fiscal rules. While the European Commission was swift to rebuke the government's plans and ask for corrections, the Italian government made really only minor tweaks and are standing their ground and setting the stage for a protracted conflict with the institution. Concerns that the budget will derail Italy's finances and the clash with EU authorities have already sent Italian bond yields soaring to a 4-year high and sparked spikes in bond yields of other countries on the periphery of the Eurozone. You can see Italy, which is the yellow line, a sharp rise in bond yields around when the government took power and with talk of the budget. You can also see our forecasts, which are the shaded part, and that we really do expect Italian bond yields to remain high or elevated. Going back to the conflict, if the conflict worsens or persists, it could also have a broader knock-on confidence in the Eurozone, while higher financing costs could hurt the banking sector, particularly for Italy's burden lenders. Italy's high debt burden in general makes it vulnerable to concerns over financial stability, and this could weigh on investment in the already slow-growing economy. Although the budget outlines a number of stimulus measures, which should give a modest short-term boost to consumption, the redistributive nature of some of these measures and the reduction in retirement age means that the budget could actually reduce the economy's growth potential, limiting any stimulus. At best, our analysts speculate that the budget will give a small, short-lived boost to GDP growth. Moreover, the likely coming standoff between EU authorities and the third biggest economy highlights the fragile political backdrop in the Eurozone and the broader struggle for cohesion among European Union members. Rising populism and political fragmentation have made passing economic and political reforms difficult in the region and really sidelined meaningful institutional EU reform for now. Well, on a positive note, we should acknowledge that France and Germany did unveil a joint paper in mid-November supporting a common budget, which was designed to breathe life back into talk of strengthening Eurozone reforms. The plan is likely to meet resistance from many countries, given the really deep divisions in the bloc at the moment and the different views of how it should go forward. On top of that, the plan could anyways take years to become a reality due to the bureaucratic nature of conducting policy in the Eurozone. Moreover, Germany's Chancellor Angela Merkel, her recent announcement that she will step down as CDU party chief in December and as Chancellor when her term ends, could create a power vacuum in the heart of Europe. Merkel has been a strong and steering force in regional politics, and it remains to be seen if there is a fit leader to take this role. Looking forward, after the United Kingdom leaves the EU in March, following a clash with Italy's government over European fiscal rules, in May there will be European parliamentary elections. I just wanted to mention them briefly because at this moment it appears that populist parties could make real gains, which could generate a lot of political noise. However, EU policy is mostly driven by heads of state, so we don't expect a real impact from this vote. On top of this, there's a lot more we could talk about when talking about the Eurozone and political risks. Several other economies are facing tough political atmospheres, especially Spain, which has a fragile government right now, as well as independence push in the Catalonia region. However, in the interest of keeping this webinar brief, we won't delve into these topics further. Now I want to move on and highlight some sort of challenges that the Eurozone will face next year. They're not so much risks, but still important to mention, as they will shape a lot of the dialogue of 2019. The first one is Brexit, which will take place in March. While Brexit risks appear to have abated somewhat since the European Union finally struck a deal with the UK on the country's withdrawal in mid-November, it is still important to mention. The agreement outlines the divorce bill, political statement on the future relationship, as well as a transition period until at least December 2020, to allow more time for the two parties to thrash out the future trading agreement. The transition period can also be extended once if needed and should help give businesses and governments more time to adjust to a change in the relationship after many years of marriage. Overall, the agreement should help reduce economic uncertainty over Brexit for a while and possibly boost economic sentiment, at least temporarily. Clarity over relations between the groups for next year and a long transition process should help investment and give firms reassurance that they will have time to adjust to any new rules or regulations. Nevertheless, while the deal has been cleared by EU members, it is uncertain if Prime Minister Theresa May will garner sufficient support for the agreement in the House of Commons. May has come under fierce criticism over the deal and seen several cabinet ministers resign. However, it is expected that the agreement will eventually pass, as it is better than the next most likely option, which would be a disorderly exit in March. While political volatility should subside for some time once the agreement is passed by the UK, Theresa May's grip on power appears very weak at the moment, and it is uncertain if she'll be able to cling on to it throughout the coming year. Even if the divorce bill is finalized, market gyrations are expected next year as the horse trading between the UK and the EU continues over the future trading relationship. Any change of leadership in the UK could really further complicate matters, especially if a more pro-Brexit MPs thrown into the mix. While Brexit is casting somewhat of a cloud on the Eurozone's outlook, especially because we might see some financial market jitters over the next year as talks progress, the Eurozone's large domestic market and the expectations that a trade agreement will remain in place should shield it really from any notable economic effects. Any economic implications are expected to be felt much more strongly in the UK. However, some economies within the Eurozone are more vulnerable to Brexit spillovers than others, especially the case for Ireland, which has a relatively high exposure to the United Kingdom. Uncertainty over Brexit has weighed on confidence in Ireland already, and consumer confidence plummeted to its lowest level in nearly 2 years in October. Moreover, a weakening pound against the euro, which you can see here in one of the diagrams, could also make Irish exports more expensive for one of their key trading partners and hurt activity that way next year. Against a tough external backdrop, one of the Eurozone's main challenges in 2019 will be monetary policy normalization. Despite recent financial volatility, lackluster economic data, and mounting growth headwinds, the ECB reiterated its plans to stay its course and halt its asset buying program at the end of December. And our analysts speculate that it will begin to raise rates next year. Unwinding extraordinary monetary policy will be challenging, and policymakers will need to strike a delicate balance between stoking growth and taming inflation, while keeping markets calm, and it is likely to proceed with caution to appease markets. The ECB has already had success in doing this by using very explicit forward guidance, especially the sentence regarding that interest rates will remain at their present levels until at least the summer of 2019. That was unveiled in the June monetary policy meeting, where the bank announced the coming end of quantitative easing. In addition, the fact that the bank plans to reinvest profits from QE going forward should help keep monetary conditions accommodative. Our consensus forecast panel currently expects inflation to remain moderate next year, giving the bank space to slowly tighten rates and keep policy accommodative overall. However, if underlying inflationary pressures surprise to the upside, there is the risk that the ECB could tighten policy faster than expected, pushing bond yields and the euro higher, which could slow growth. Flipside risks also exist, and delayed tightening could buttress momentum for longer and be an upside risk to our growth forecast. In the same year that the bank begins walking this tightrope to monetary policy normalization, it will also face a key leadership change. ECB President Mario Draghi's term will end in October, and his successor will face the task of continuing to gradually unwind stimulus and rebuild the bank's buffers before the next downturn. Several candidates are potentially in the running, and jockeying over the position will focus on more than just expertise. Nationality and possibly gender could also be thrown into the mix. Overall, barring any major economic surprises, FocusEconomics panelists see the bank slowly raising the policy rate towards the end of 2019. However, as you can see in this distribution graph, there is some divergence between our analysts on the strength of tightening, and some think that rates could even stay on hold for longer, while some believe that rates will rise faster than others, adding uncertainty or risk to our forecast. After going over some of the broader risks as well as challenges to the Eurozone, I would like to wrap up by taking a quick look at the region's two largest economies, Germany and France, and their prospects for next year in more detail. Let's start with Germany. Germany's economy, the engine of Europe, recently saw its robust growth streak come to a grinding halt. The economy contracted for the first time in over 3 years in the third quarter, falling 0.2% on a quarterly basis. However, the third quarter's reading is not cause for alarm. While softer global trade has had an impact on investment and export growth, the contraction was likely driven also by some one-off factors, in particular the impact of new emissions tests on car producers. The country's outlook for next year is still healthy, although growth is seen slowing in line with the Eurozone at large. Record low unemployment should power the domestic economy, while a minimum wage hike to be introduced at the start of the year should put extra money in consumers' pockets. However, the economy is vulnerable to global trade woes, and a worsening in trade relations could hurt its powerful manufacturing sector. Moreover, as I mentioned earlier in the presentation, the political scene is challenging. Angela Merkel's party has lost support in recent local elections, and the increasing strength of the conservative wing could limit her ability to pass legislation in a context of slowing growth. In addition, the power vacuum, when she steps back from politics, is a cloud on the country's horizon. However, overall, our outlook for Germany is positive, and FocusEconomics sees GDP expanding 1.7% next year, powered by healthy private consumption growth. Now let's look at next year's prospects for the bloc's second largest economy, France. Economic growth notched higher in the third quarter of this year after a weak first half of the year. Household spending rebounded on higher expenditures for energy and transport amid the return to normal temperatures and an end to public transit strikes, while investment also picked up. Temporary factors that have weighed on activity in 2018 are starting to fade, and this should continue next year, fueling a pickup in private consumption. However, growth overall is seen remaining broadly stable due to a deteriorating external sector. Household spending next year is seen benefiting from income tax cuts and an improving labor market, while fixed investment should hold up amid Macron's reform push, elevated capacity utilization, and upbeat economic sentiment. However, downside risks include a pullback in global trade and any escalation of the US-China trade spat, either of which could bruise exports next year. While the country overall has made progress in getting its finances in order, it has a very high public debt load, which is still a cause for concern when examining its economy. On the political front, a lack of reforms next year is also a key risk. President Macron's approval ratings have been sinking amid cross-country fuel tax protests, and his faltering popularity has increasingly called into question his ability to push through long overdue economic reforms, which could give a boost to our long-term growth prospects for France if enacted. Well, that brings us to the end of the webinar. I just wanted to wrap up with our bottom line for the Eurozone economy. This year, the recovery entered a lower cruising speed after growth peaked in 2017 at a decade high, and growth slowed notably in the third quarter. We expect the economy to regain some traction in the final quarter of this year and remain broadly stable in 2019, growing at a healthy but slower pace. Healthy activity will be driven primarily by domestic dynamics, most notably the bloc's improving labor market and still accommodative monetary policy. However, a tough external environment due to global trade tensions and volatile financial markets should provide less support than in years past for the economy. While political troubles over Brexit, Italy's populist government, and Eurozone political fragmentation could plague sentiment and pose risks to our outlook. Moreover, the bloc will face several challenges next year. The United Kingdom will officially leave the European Union in March. EU parliamentary elections will take place against a backdrop of a fractured union, and the ECB will start normalizing monetary policy, as well as see a power switch in the top job. Overall, our FocusEconomics panelists project GDP to expand 1.7% in 2019, and growth is seen softening slightly to 1.6% in 2020. I wanted to thank you all for listening, and I hope you enjoyed this webinar on the Eurozone economy.